Get ready because a critical update to your monthly income is arriving right now, and what you don't know about it could cost you. We need to talk about the January Social Security deposit hitting accounts, because this isn't just another payment. It's the first one reflecting a major federal adjustment for the new year. Millions are watching for it, but the real story is in the details most will completely overlook. If your birthday lands between the 11th and the 20th of any month, your money arrives tomorrow. The government uses a strict calendar based on your birth date. The second Wednesday for the 1st through the 10th, the third Wednesday for the 11th through the 20th, and the final Wednesday of the month for those born from the 21st to the 31st. This schedule dictates the cash flow for over 71 million people, and knowing your exact date is the key to managing your bills and your budget without stress. A 2.8% annual boost has been applied, which sounds great on paper. The typical retiree will see their check grow by about $56. But what if I told you a significant portion of that increase might never actually reach your pocket? We have to dive into the fine print. This January deposit is fundamentally different from every other check you received last year. The cost of living adjustment, or COLA, has officially been calculated into your benefit. While that seems like pure positive news, the situation on the ground is far more layered. That $56 figure you've heard? It's just an average. Your personal raise is a straight percentage, 2.8%, applied to your unique benefit amount. So if your current monthly payment is above average, your dollar increase will be bigger. If it's below, your raise will be smaller. Some will see an extra $30, others might get $80 more. The crucial step is to ignore the headlines and look at your own statement when it comes. Now here's the reality check that shocks people every single year. Why does that promised boost often feel so much smaller in reality? The answer is Medicare. Specifically, the monthly premium for Medicare Part B is climbing, and it climbs fast. For 2026, it's rising from $185 to $202.90. That's nearly an $18 jump. And for the vast majority, this premium is deducted directly from your Social Security payment before the money ever touches your bank. Think about that. Of your $56 average increase, almost 1/3 instantly vanishes to cover this healthcare cost. Does it feel frustrating that after decades of paying into the system, your net gain gets trimmed back? Absolutely. But it highlights a brutal truth. Medical expense inflation is racing ahead of general inflation. This 9.7% hike in Part B is over 3 times larger than your Social Security percentage increase. We're now in the third straight year where Medicare's growth has outpaced the COLA, a trend that quietly erodes the real spending power of retirees. Let's make this concrete with an example. Imagine your 2025 benefit was $2,000 monthly. With the 2.8% boost, your new gross amount becomes $2,056. That's the $56 increase. But now the deduction happens. Last year, Medicare took $185, leaving you with $1,815. This year they take $202.90. So your actual spendable deposit is just $1,853,000. Your real tangible increase? Only $38,000. That's a huge gap from the headline number. Is your financial planning prepared for that difference? There is a safeguard for some known as the hold harmless rule. It protects about 4 million people, usually those with the very lowest benefits, from seeing their net check shrink due to Medicare hikes. If your monthly benefit is around $640 or less, your premium increase is capped so your payment doesn't go down. Your check stays flat. You don't gain, but you don't lose. However, this protection has major exclusions. It does not apply if you're new to Medicare in 2026, if your income is high enough to trigger an IRMAA surcharge, or if you're on a Medicare savings program. Speaking of IRMAA, this is a major pitfall. These income-related monthly adjustment amounts use your tax return from 2 years ago to determine your premium. So your 2026 cost is based on your 2024 earnings. If you filed single and your modified adjusted gross income topped $103,000, or married filing jointly over $206,000, you'll pay extra, anywhere from $81 to nearly $500 more per month, on top of the standard premium. About 8% of beneficiaries face these surcharges, and Hold Harmless offers them no shield. And it's not just Part B. If you have a Part D drug plan or a Medicare Advantage plan, those premiums, which are also rising, come out of your check too, with no protection at all. This is why experts beg people to review their Medicare options every fall during open enrollment. A better plan could save you serious money. Now for some genuinely good news tucked into recent legislation. A new senior deduction could save you a bundle at tax time. If you're 65 plus, you can claim an extra $6,000 deduction on your federal return, on top of the standard deduction and the existing senior bonus. A couple both over 65 could see a $12,000 combined break. But, you knew there was a but, it phases out with higher income. The full benefit is for single filers under $75,000 and married couples under $150,000, using modified adjusted gross income. Above that, it dwindles and disappears entirely at $175,000 for singles and $250,000 for joint filers. Also, this break is temporary, set to expire after the 2028 tax year. What does this mean for your wallet? For someone in the 12% tax bracket, that's about $720 in savings. In the 22% bracket, it's roughly $1,220. It won't fatten your monthly deposit, but it will help when you settle with the IRS. Don't confuse this with making Social Security itself tax-free. That didn't happen. The old rules still apply. If your combined income is between $25,000 and $34,000 single, or $32,000 and $44,000 married, up to 50% of benefits may be taxable. Above those limits, up to 85% can be taxed. These thresholds haven't changed since the 1990s, so inflation pushes more people into taxability each year. The smart move is to see how all these pieces connect. If you're near an income cliff, for the senior deduction phase-out, for benefit taxation, or for IRMAA, you might adjust your financial moves before year-end. Maybe delay a large withdrawal or a Roth conversion. This is where a chat with a tax pro who knows retirement rules is invaluable. Let's revisit the payment calendar because timing is power. Born on the 1st 10th? You're paid on the 2nd Wednesday. Born 11th 20th? It's the 3rd Wednesday. Born 21st 31st? Your money comes the 4th Wednesday. The exceptions are those who started benefits before May 1997 and SSI recipients. They have their own schedule. Knowing your date prevents budget shortfalls and late fees. The big picture problem remains. Benefit increases often fail to match the actual costs retirees bear, especially for healthcare. The COLA uses a general inflation index that reflects younger working families' spending, not the medical-heavy budgets of seniors. Proposals to use a senior-specific index have stalled in Congress. Until that changes, many will feel they're running in place. Also, Medicare's Part B deductible is rising from $257 to $283, and the Part A hospital deductible jumps from $1,076 to $1,136. These are direct out-of-pocket hits. One final note for those still working. The maximum earnings subject to Social Security tax is increasing from $176,100 to $184,500 in 2026. This funds the system, but reminds us of its long-term strains. Managing retirement finances means staying alert to all these interconnected factors. Your Social Security is a cornerstone, but it's one piece. Annually review your Medicare plan, check your tax withholding, and adjust your spending to the real net amount you receive. Knowledge isn't just power, it's cash in your account. If this breakdown helped you see your finances more clearly, do us a huge favor and hit the like button. It truly supports the channel and helps us keep making content for you. Thanks for watching my channel.